The riskiest thing you can do at 65 is play it completely safe. That statement probably sounds wrong to you, perhaps even dangerous. After all, you've spent decades building what you have. The last thing you want now is to gamble it away chasing returns you don't need, taking risks you can't afford. And you'd be right to think that way. But here's what most people miss in that very reasonable caution. There's a difference between being reckless and being paralyzed, between speculation and preparation, between gambling and growing. Benjamin Graham understood this better than almost anyone who ever lived, not because he was fearless, but because he had been terrified. He knew what it meant to lose everything. He knew what it felt like to watch wealth evaporate. And from that knowledge, from that deep understanding of both prosperity and collapse, he built something remarkable, a philosophy of investing so simple, so sturdy, so deeply grounded in reality that it has protected generations of people through every imaginable crisis: wars, depressions, market crashes, technological revolutions, political upheaval. Through it all, his principles held. Before we go further, let me be clear about something important. Nothing you hear in this conversation constitutes financial advice. I'm not your advisor, and I don't know your specific situation, your needs, your goals, or your circumstances. What I'm offering you is perspective, education, the documented wisdom of a man who spent his entire life studying how wealth is built and preserved. What you do with that wisdom is entirely your decision to make, preferably in consultation with professionals who know your full picture. Now then, let's talk about what Graham discovered and why it matters so much after 65. Graham was born in 1894 in London, but his family moved to New York when he was still a baby. His father died when Benjamin was 9. His mother tried to maintain their standard of living by taking in boarders and speculating in the stock market. The speculation didn't go well. By the time he was a teenager, Graham knew what it meant to be poor. He knew what it meant to watch his mother make financial mistakes driven by desperation and hope. He knew what it meant to need money badly enough to make bad decisions about it. That knowledge stayed with him forever. He was brilliant academically. Columbia University offered him teaching positions in 3 different departments when he graduated: mathematics, philosophy, English literature. He chose none of them. He went to Wall Street instead, starting as a clerk at a bond trading firm. Within a few years, he was analyzing securities. Within a decade, he was managing money. Within 2 decades, he was teaching at Columbia Business School and writing books that would change how the world thinks about investing. But here's what matters about Graham's story. He didn't just study investing from a safe distance. He lived it. He made money. He lost money. He experienced the 1929 crash and the depression that followed. His partnership lost 70% of its value between 1929 and 1932. 70%. Everything he had built nearly wiped out. Most men would have been destroyed by that. Some were. Graham looked at the wreckage and asked himself a question that would define the rest of his life. How do you build wealth in a way that survives the worst the world can throw at you? The answer he arrived at was so simple it sounds almost naive when you first hear it. But simplicity isn't the same as easy, and it certainly isn't the same as naive. Graham's philosophy rested on 3 interconnected ideas that formed a kind of financial fortress. First, that the market is not a rational machine for valuing companies, but a voting mechanism driven by human emotion. swinging wildly between fear and greed. Second, that you can protect yourself from those swings by buying things for significantly less than their worth and holding them until the market recognizes their value. Third, that diversification and margin of safety aren't optional luxuries, but essential requirements for survival. Let's talk about what that actually means when you're 65 years old. By the time you reach retirement age, something fundamental has changed in your relationship with money. When you're young, you have time to recover from mistakes, time to ride out crashes, time to rebuild. But after 65, time becomes your scarcest resource. You might have 20 years ahead of you. You might have 30. But you don't have 40. You don't have 50. The margin for error has narrowed. Not disappeared, but narrowed significantly. This is where most retirement advice goes wrong. It treats this narrowed margin as if it means you should stop growing your money entirely, park everything in bonds or certificates of deposit, accept returns that barely keep pace with inflation, play it so safe that your purchasing power slowly erodes year after year. That's not safety. That's slow-motion financial suffocation. Graham saw through this false choice. He understood that the real risk in retirement isn't volatility. It's running out of money before you run out of life. It's watching your purchasing power decline as prices rise and your fixed income buys less and less. It's being 85 years old and wondering how you're going to afford the medication you need or the care you require. Here's the truth no one talks about. If you retire at 65 with $1 million and you need $40,000 a year to live on, you cannot afford to earn 3%. You need growth, not speculation, not gambling, but steady, reliable, intelligent growth that keeps pace with inflation and provides the income you need without forcing you to deplete your capital. This is where Graham's philosophy becomes not just relevant, but essential. He taught something he called the margin of safety. The idea is beautifully simple. When you buy something, buy it for significantly less than it's worth. If a company's true value is $100 per share, don't pay $95. Don't even pay $80. Pay $60. Pay $50 if you can. That gap between price and value is your cushion, your protection, your margin of safety. Why does this matter after 65? Because it means you're not depending on everything going right. You're not betting that the market will be rational, or that your timing will be perfect, or that nothing will go wrong. You're building in protection from the beginning. You're assuming things will go wrong sometimes, and you're planning for it. Graham applied this thinking to everything. He didn't just look for cheap stocks. He looked for cheap stocks in stable businesses with real assets and consistent earnings. He wanted companies that sold products people needed, not just wanted. He wanted businesses with strong balance sheets and reasonable debt levels. He wanted management that was competent and honest. And he wanted to buy all of that at a price that made sense even if the next few years were terrible. Consider what this means in practical terms. Let's say you own a portfolio of 20 or 30 different companies, all purchased with a significant margin of safety, all solid businesses with real earnings and tangible assets. You've paid 60 cents on the dollar for each one. Now the market crashes. Your portfolio drops 30%. It hurts. It's scary. But you haven't lost money in any real sense because you didn't pay full price to begin with. You bought at 60 cents. Now you're at 42 cents. But the underlying value hasn't changed. The businesses still make products. They still earn profits. They still have assets. The price has fallen, but the value is still there. This is the psychological fortress Graham built. When the market panics, you don't have to. When everyone else is selling in terror, you can hold steady. Not because you're brave, but because you're grounded in reality. You know what you own. You know what it's worth. And you know you paid a reasonable price for it. But there's more to it than that. Graham also understood something profound about human nature and investing. He understood that the greatest enemy of good returns isn't market crashes or economic recessions. It's your own behavior. It's the temptation to buy what's popular and expensive because everyone else is buying it. It's the urge to sell what's unpopular and cheap because everyone else is selling it. It's the inability to sit still and do nothing when doing nothing is exactly what the situation requires. After 65, this becomes even more critical. You've lived long enough to see patterns. You've watched markets rise and fall. You've seen fortunes made and lost. But you've also accumulated fears and scars. You remember losses. You remember mistakes. And those memories can paralyze you at exactly the wrong moments or panic you into action when patience is what's needed. Graham's solution was ruthlessly simple. Create rules and follow them. Not complex rules, not constantly changing rules. Simple, clear, tested rules based on value and safety. Then stick to them regardless of what the market is doing or what your emotions are screaming at you to do. He had a rule about diversification. Never let any single investment represent more than 10% of your portfolio. This wasn't about missing out on big winners. It was about surviving big losers. If one company fails completely, you lose 10%. Painful, but survivable. If you had half your money in that company, you lose 50%. At 65, you may never recover from that. He had rules about debt, corporate debt specifically. He wanted companies with minimal debt relative to their assets. Why? Because debt magnifies everything. In good times, it amplifies gains. In bad times, it amplifies losses and can destroy companies entirely. Graham had seen too many solid businesses get crushed by debt they took on during optimistic times. He wanted businesses that could survive pessimistic times. He had rules about earnings. He wanted companies with consistent earnings over many years, not just one or two good quarters. This wasn't about perfection, it was about reliability. He wanted to see that a business could make money year after year through different economic conditions. That told him something important. This company knew how to adapt. It knew how to survive. And he had rules about price. This was his most fundamental rule. The price you pay determines your return. Pay too much for even a wonderful business, and you'll get mediocre returns at best. Pay a reasonable price for an average business, and you can do quite well. Pay a bargain price for a decent business, and you'll almost certainly profit over time. Let's pause here and consider what this philosophy does for someone in retirement. First, it removes the need to be brilliant. You don't need to predict the future. You don't need to identify the next Apple or Amazon. You don't need to time the market perfectly or outsmart professional traders. You just need to be disciplined and patient. You need to follow simple rules and let time work in your favor. Second, it protects you from your own worst instincts. When the market is soaring and everyone around you is bragging about their returns, Graham's rules keep you grounded. They remind you that high prices are dangerous regardless of how good the story sounds. When the market is crashing, and everyone is panicking, those same rules remind you that low prices create opportunity if you're buying solid businesses. Third, it gives you something precious, peace of mind. When you know you've bought good businesses at reasonable prices, when you know you're diversified across many different companies, when you know you have a margin of safety built into every position, you can sleep at night. You don't need to check your portfolio every day. You don't need to panic over headlines. You can live your life. This is what Graham figured out after losing 70% of his money in the Depression. The goal isn't to maximize returns. The goal is to build wealth in a way that lets you sleep at night and survive the worst the world can offer. Maximum returns are wonderful if you can get them, but survival comes first. Steady, reliable, boring growth comes first. Sleep comes first. There's a story about Graham that illustrates this perfectly. Late in his life, long after he'd become famous, a young investor asked him what he considered his greatest achievement. The young man expected Graham to mention his books, or his teaching, or his investment returns. Graham said none of those things. He said his greatest achievement was learning to be patient, learning to wait, learning to do nothing when nothing was the right thing to do. Think about what that means. Here was a man who had trained some of the most successful investors in history, a man who had written books that generations of investors studied like scripture, a man who had built enormous wealth for himself and his clients. And when asked about his greatest achievement, he talked about patience, because patience is what makes everything else possible. Patience lets you wait for the right price instead of chasing expensive stocks. Patience lets you hold through market crashes instead of selling at the bottom. Patience lets you collect dividends and reinvest them year after year, letting compound growth work its quiet magic. Patience lets you ignore noise and focus on substance. After 65, patience becomes both easier and harder. Easier because you've lived long enough to see patterns repeat. You know that crashes always recover eventually. You know that panic is usually wrong. You know that most of what seems urgent today will be forgotten tomorrow. But harder because you're aware of time. You know you don't have decades to wait for things to work out. You need your money to work now, or at least soon. Graham's approach solves this tension. By buying quality businesses at significant discounts, you're not waiting for decades of growth to justify your purchase. You're buying something that's already worth more than you paid for it. Your profit is built in from day one. You're just waiting for the market to recognize what you already know. Sometimes that takes 6 months, sometimes 2 years, sometimes 5. But you're not dependent on the future being wonderful. You just need the future to be reasonable. Let me show you something about how this works with dividends, because this is where Graham's philosophy becomes especially powerful for retirees. Many of the companies Graham favored paid dividends. Steady, reliable dividends from real earnings. These weren't speculative growth companies promising pie in the sky. These were established businesses sharing their profits with shareholders. When you buy these companies at a significant discount, something interesting happens with those dividends. Let's say you find a company worth $100 per share that pays $4 in annual dividends. But you're patient. You wait. And eventually, you're able to buy it for $60. Now that $4 dividend represents a 6.7% yield on your purchase price. Same company, same dividend. But because you waited for the right price, your income is significantly higher. Do this across 20 or 30 different companies, and you've built yourself an income stream. Not from depleting your capital, but from the earnings of businesses you own. Those businesses keep operating, keep selling products, keep earning profits, keep paying dividends. Your capital stays intact. In fact, if you've bought at the right prices, your capital grows over time as the market price moves toward the true value. But even if it doesn't, even if prices stay stagnant, you still have your dividend income. This is survival investing. This is how you build a portfolio that can support you for 20 or 30 years without running dry. Not by betting on growth stocks or speculating on trends. By owning pieces of solid businesses bought at reasonable prices that share their profits with you year after year. Graham was asked once why he focused so much on dividends and tangible value rather than growth and potential. His answer was simple. I want to eat regularly. There's profound wisdom in that plain-spoken statement. He wanted returns he could count on. Returns that came from real business operations, not from hoping someone else would pay a higher price later. Returns that would continue even if the market closed down for a year. Think about what that means for retirement planning. Most people approach retirement with some version of the 4% rule. You can safely withdraw 4% of your portfolio each year. And if things go reasonably well, your money should last 30 years. But that rule is built on assumptions. It assumes market returns will follow historical patterns. It assumes inflation will remain moderate. It assumes you won't need large unexpected expenses. Graham's approach is different. He's not assuming anything will go well. He's building a portfolio that produces income from real business operations. If those businesses pay 5% in dividends and you need 4% to live on, you have cushion. If some companies cut dividends in bad years, others will maintain them. If the market crashes, your income stream doesn't disappear because it's not dependent on stock prices. It's dependent on business earnings. This is the fortress. This is the protection, not from every possible problem, but from the most likely problems, not from short-term volatility, but from long-term depletion. Now, Graham wasn't naive. He knew that even solid businesses could fail. He knew that dividends could be cut. He knew that unexpected things happen. That's why he insisted on diversification. 20 companies minimum. 30 is better, spread across different industries, different types of businesses, different economic exposures. This way, if 3 or 4 disappoint, you're fine. If 1 or 2 fail completely, you're still fine. You're not dependent on any single thing going right. He also knew that the world changes. Industries rise and fall. Technologies emerge and make old businesses obsolete. That's why he focused on businesses with durable advantages. Companies that made products people needed, not just wanted. Companies with strong market positions that couldn't easily be displaced. Companies with assets and earnings, not just promises and potential. There's a deeper pattern here that's worth understanding. Graham lived through enormous change. He was born in the age of horses and died in the age of computers. He saw radio, television, air travel, nuclear power, space exploration. He saw entire industries created and destroyed. Through all of that change, his principles remained constant. Not because he was stubborn or old-fashioned, but because he understood something fundamental. While the world changes constantly, human nature doesn't. Fear and greed still drive markets. Panic and euphoria still create opportunities. And the basic mathematics of value still work the same way they always have. This is liberating when you're older. You don't need to understand the latest technology or the newest business model. You don't need to figure out which artificial intelligence company will dominate or how cryptocurrency will evolve. You can let younger investors speculate on those things. Your job is simpler. Find solid businesses trading below their value, buy them, hold them, collect your dividends, and sleep well. Graham had a student who became rather famous in his own right. You might have heard of him, Warren Buffett. Buffett has said many times that the most important thing Graham taught him wasn't a formula or a strategy. It was an attitude, an emotional framework for thinking about investing that protected him from his own worst impulses and from the crowd's madness. Buffett tells a story about Graham's classroom at Columbia. Graham would describe Mr. Market, an imaginary business partner who showed up every day offering to either buy your share of the business or sell you his share. Some days, Mr. Market was optimistic and offered high prices. Other days, he was pessimistic and offered low prices. Graham's insight was simple. You don't have to accept either offer. You can ignore Mr. Market completely when his prices are ridiculous. You can transact with him only when his prices are advantageous to you. This metaphor seems almost childish in its simplicity, but it contains profound wisdom for retirees. The market will offer you prices every single day. Most of those prices will be wrong, too high or too low, driven by emotion rather than value. Your power lies in choosing when to transact and when to simply ignore the noise. After 65, this becomes a superpower. You're not forced to do anything. You don't need to buy when prices are high just because you have cash to invest. You can wait. You don't need to sell when prices are low just because the market is scary. You can hold. The daily noise of market prices becomes irrelevant. What matters is value. What matters is the actual businesses you own and the income they generate. Graham spent his later years teaching and writing. He'd made his money. He'd proven his methods. He could have kept managing funds and extracting fees. Instead, he focused on education, on passing along what he'd learned, on helping others avoid the mistakes he'd made and replicate the successes he'd achieved. There's a lesson in that transition, too. After a certain point, it's not about accumulating more. It's about preserving what you have, enjoying what you've built, and finding meaning in something beyond addition. Graham found meaning in teaching, in helping others understand principles that could protect and serve them, in building something that would last beyond his own life. This is the final piece of wisdom for retirees. The money matters, the strategy matters, the principles matter, but they're not the ultimate point. The ultimate point is having enough so that you can focus on what actually gives your life meaning. Family, friends, interests, contributions, peace. Graham's investment philosophy was never about becoming as rich as possible. It was about having enough, about building financial security solid enough that you could stop worrying about money and start living whatever time remained to you. He wrote late in his life that he wished he'd spent less time on Wall Street and more time on other things. He'd been successful by any measure, but success had cost him marriages, relationships, time with his children. He didn't regret his career, but he was honest about the trade-offs. This honesty is rare and valuable. It reminds us that investment strategy, no matter how brilliant, is only a tool. The point isn't the tool. The point is what the tool enables you to build and experience in your life. So here's what Graham's philosophy offers to someone past 65. A way to grow your money steadily and safely. A way to generate income without depleting the capital. A way to sleep at night, regardless of what markets are doing. A way to protect yourself from both your own emotions and the crowd's madness. A way to focus on living rather than worrying. The strategy itself is almost boring in its simplicity. Buy good businesses at good prices, diversify broadly, focus on companies with real earnings and real assets, collect dividends, hold patiently, ignore market noise, let time and value do their work. There are no secrets, no complex formulas, no sophisticated techniques, just clear thinking, patience, and discipline applied consistently over time. But that simplicity is deceptive. Simple doesn't mean easy. Following these principles requires you to go against the crowd regularly, to buy when others are selling, to hold when others are panicking, to remain calm when the world seems to be falling apart, to ignore hot tips and exciting stories, to be content with steady, unspectacular returns when others are bragging about doubling their money. This is where character intersects with strategy. Graham believed that successful investing was at least as much about temperament as about intellect. You could be brilliant and still fail if you couldn't control your emotions. You could be average intelligence and succeed if you had the right psychological foundation, patience, discipline, emotional stability, independence of thought. These qualities mattered more than IQ or education. Think about what this means for you personally. You've lived 6 or 7 decades, you've accumulated experience, you've learned things about yourself, you know your tendencies, your weaknesses, your fears. Graham's philosophy works with that self-knowledge rather than against it. If you know you tend to panic when prices fall, his margin of safety and diversification principles protect you. If you know you're tempted by exciting stories, his focus on proven businesses with tangible value keeps you grounded. If you know you struggle with patience, his emphasis on dividends gives you something tangible to hold on to while you wait. The philosophy adapts to who you are. It doesn't require you to become someone else. It just requires you to be honest with yourself and build protections around your known weaknesses. Graham died in 1976 at the age of 82. He'd lived through 2 world wars, the Great Depression, multiple recessions, the rise and fall of countless companies and industries. He'd seen his own wealth nearly destroyed and then rebuilt. He'd taught thousands of students and influenced millions through his writing. Near the end, someone asked him if he had any regrets about his investment philosophy. He said no. The principles had worked exactly as he'd intended. They'd provided safety, steady growth, and peace of mind. What more could you ask from an investment approach? What more indeed? The sun sets on every life eventually. We spend the first part building and accumulating and proving ourselves. We spend the middle part managing and maintaining and adapting. And if we're fortunate, we spend the final part simply being, enjoying what we've built, sharing what we've learned, finding peace in sufficiency rather than always reaching for more. Graham's investment philosophy is ultimately a philosophy of sufficiency, not of poverty or scarcity or settling for less than you deserve, but of building enough so that you can stop worrying, so that you can focus on what matters, so that you can live whatever years remain to you with dignity and peace and security. The strategy itself is just numbers and principles. Buy value, diversify broadly, focus on quality, hold patiently. But the result of following that strategy is something far more precious than money. It's freedom from financial fear. It's confidence that you'll be okay regardless of what happens. It's the ability to sleep at night. It's peace. You've worked 40 years or more to accumulate what you have. Graham's gift to you is a way to preserve it, grow it steadily, and generate income from it without taking foolish risks or losing sleep. It's not exciting. It won't make you rich overnight. It won't give you stories to brag about at parties. But it will do something more important. It will work year after year, through crashes and booms, through chaos and calm. It will work because it's grounded in reality rather than hope, in value rather than speculation, in patience rather than urgency. The simplest strategy is often the hardest to follow, not because it's complex, but because it requires you to stand apart from the crowd, to be calm when others panic, to be patient when others chase, to be disciplined when others indulge, to be content with enough when others always want more. But that difficulty is also where the power lies. Because if it were easy, everyone would do it. And if everyone did it, it wouldn't work anymore. The very fact that most people can't or won't follow these principles is what makes them effective for those who can and will. You're past 65 now. The time for speculation has passed. The time for proving yourself has passed. The time for taking unnecessary risks has passed. What remains is something more important: the time for living well with what you have, the time for security and peace, the time for confidence that you'll be okay. Benjamin Graham showed you how to get there. The path is clear. The principles are tested. The strategy works. All that remains is the decision to follow it, to embrace simplicity over complexity, patience over urgency, value over hype, peace over anxiety. The choice, as always, is yours. But know this: millions of people have walked this path before you. They've followed these principles through decades of investing, through crashes and recoveries, through fear and euphoria. And they've arrived safely on the other side, not because they were smarter or luckier or more talented, but because they were disciplined, patient, grounded in reality. You can be too. The sun is setting, the day is ending. But there's still light enough to see the path ahead, still time enough to walk it with confidence, still life enough to live it with peace. That's what Graham understood in the end. That money is just a tool. That investing is just a means. That the real goal is living well. And that living well requires just two things: enough resources to be secure and enough wisdom to be content. You have the resources. Graham gave you the wisdom. The rest is simply walking forward, one patient step at a time, into whatever years remain, steady, secure, at peace. That's the simple strategy that ensures you'll never run out of money after 65, not because it makes you rich, but because it makes you safe. And sometimes, especially at this stage of life, safety is the greatest wealth of all.